Good morning, everyone, and welcome to the first keynote of this year's New Jersey Planning and Redevelopment Conference. New Jersey Future and APA New Jersey are pleased to host this keynote, which explores New Jersey's post-pandemic real estate landscape and economic trajectory. I'm Tim Evans, and I'm the Research Director of New Jersey Future, where I work on initiatives related to transportation, housing, aging and friendly communities, among other things. And these are just some of the areas in which New Jersey Future conducts research to ensure healthy, strong, and resilient communities. It's my honor today to introduce the keynote given by Jeff Otteau called The Future of New Jersey, an Economic and Real Estate Forecast. Those of you who have heard Jeff speak at our conference in the past know that this is kind of like the state of the state for data nerds. First, a special thanks to the title sponsor of the conference, PSEG. And I also want to thank today's keynote sponsors, New Jersey's Clean Energy Program, Rowan University School of Earth and Environment, CSG Law, Inglesino Taylor, the New Jersey Economic Development Authority, New Jersey Natural Gas, and PNC Bank. Before we get started, a few reminders. As you share your photos, experiences, and lessons learned through social media, please use the hashtag NJPRC24. At the end of today's keynote, we'll have time for audience questions. Please remember to use the Q&A function to enter your questions for Jeff, which is separate from the chat function. Q&A is below the screen, chat box is to the right. So use Q&A to submit questions to Jeff. And now it is my pleasure to hand it over to Jeff Otteau, the managing partner and chief economist for the Otteau Group and managing broker of Hudson Atlantic Realty Advisors. Take it away, Jeff.
Thank you, Tim, and greetings, everyone. We have lots to talk about, so I'm going to get started very quickly. But first, some context. With the onset of the pandemic, the United States and New Jersey experienced the most severe and rapid economic downturn in history, in all of history. To give you a sense of the scale of that, in the early months following the declaration of pandemic, the United States lost 22 million jobs, which were eliminated by businesses inside of a 6-week period. Never has anything on that scale ever occurred in all. And then afterwards, there was a surprisingly rapid economic recovery, due largely to the intervention of the federal government to try and limit the downsides. And with that, initially, a rapid return to normal for most of the real estate economy in all. Fast forward that to the last 2.5 years, and that economic recovery and expansion became so strong that it turned up the dial on inflation, cost of living, food prices, gasoline prices. And that in turn led to the raising of interest rates. And we'll talk a little bit about that dynamic in a few moments. Most of the real estate markets reacted as expected, meaning that they cooled down in response to higher interest rates. But that did not happen in the housing market. In the New Jersey housing market and in other markets around the country, real estate prices continued to accelerate for the first time in history during a period of rising interest rates. And now we find ourselves today trying to understand what comes next. I'm going to bring up my presentation now so we can see the slides, which you should be seeing. Here are the topics that I'll be speaking to today. We'll start with sort of an update on where we stand in the economy, and most importantly, when we might expect interest rates to begin to cool. We'll then see an update on what's been happening with the context of who lives in New Jersey. And I can tell you that we've returned to the long-term average or norm of seeing more out migration than in migration. That was not true in the initial months following the onset of the pandemic, where there were very large numbers of people and households moving out of New York City and coming into New Jersey. And the same would be true for Southern New Jersey with its relationship with Philadelphia. But more recently, we're seeing that out-migration has kicked up again. We'll talk about some of the reasons for that and what the implications are going forward. Next, a look at what's occurring with construction spending. And as I expect you're aware, the big boom in construction activity in New Jersey in recent years has been for multifamily apartments and warehousing. And we'll look to see if there are any signs that that trend may be changing. Next, a quick lap around the real estate monopoly board to see how the various real estate sectors are performing: housing, industrial, and commercial real estate as well. And then finally, a look forward with a focus on how should we be planning for New Jersey's future. Starting out with the economy, I want to take a moment to be sure that you understand why we have high interest rates. And the principal reason here is that we have an economy which is overheated. It's much stronger than would be optimal. And when an economy becomes overheated, that causes the price of goods and services to inflate, which in turn leads to higher interest rates. How did we get to this point of having an overheated economy? Well, the federal government, following the onset of the pandemic, understood the worst case scenario that could have occurred. As I mentioned earlier, 22 million people lost their jobs inside of a 6-week period. That's never happened before. And in reaction, began to implement various stimulus packages and incentive packages to try to create a soft landing so that we would not all see that worst case scenario. And in the end, the federal government ended up doing more than perhaps it should have in trying to insure against the downside. And as a result, we have an economy today which is too good to the extent that it's starting to drive inflation. When an economy is overheated, that causes more employment, more income, and then more spending. And more spending leads to inflation. And when you have inflation, higher interest rates are an inevitable outcome. And the reason for that is that what inflation really tells us is that what you can borrow with your money, with $1 or $100 or 1,000 of your dollars, what you can buy with it in the future is less than you could at the start. That's inflation. In a 5% inflationary environment, what used to cost $1 costs $1.05 a year from now. And so your dollar is now really only worth 95 cents because of its deflated purchasing power. And in reaction to that, lenders of money must increase the interest rate that they charge in order to offset, to mitigate the fact that borrowers are paying the lender back with dollars that are less valuable due to inflation than when the money was lent in the beginning. And so all of this is the dynamic that we find ourselves in today. And I can tell you that the way that this gets cured is that when the Federal Reserve and the money markets push interest rates higher and higher, that makes the cost of living less affordable for consumers and businesses, which causes them to spend less and essentially lowers the rate of inflation and cools the economy. And here you get to see the trajectory that we're on right now. This is a national number. We're looking at what's called GDP. Essentially, it's the growth rate of the economy. And following a fairly comfortable decline in the first quarter of this year from 2.5% down to a 1.6% growth rate, the economy right now is accelerating again. And it's in the current quarter on a 3.5% trajectory growth pace. The rate at which the economy is growing more or less will correlate to the rate of inflation. And that we have seen recently, since April and May, that the economy is actually growing faster. That's why we've not seen the Federal Reserve decide to begin to lower interest rates just yet. Here's sort of the backstory on that overheated economy. You see over here on the left the massive number of job losses that occurred in the early months following the pandemic, 22 million nationally, about 300,000 here in New Jersey. The full recovery of that more recently, so that we now have more people working than at any time in prior history. That, of course, creates income. Income gets spent, and that's why consumer spending also continues to occur at record high levels. In reaction to that, we saw inflation accelerate quite a bit from around 2.5% pre-pandemic up to 9% in the summer of 2022. And since then, you can see that we've come a long way in curing the high inflation that we had back then. Inflation has essentially fallen by 2/3 from 9% down to in the range of 3.5%. That is significant progress. But it's nowhere near what the Federal Reserve sets as a 2% target line, as being the level below which the Fed feels able to begin to lower interest rates. And so, yes, we've seen inflation fall by 2/3 over the last couple of years. However, it still remains more than 50% above the target line set by the Fed. And so what this tells us is that we are going to continue to have high interest rates and all of their effects on demographics, on spending, on real estate markets for a while longer yet. Here you can see how the inflation problem has pushed interest rates dramatically higher. Pre-pandemic, 30-year fixed mortgages were averaging around 3%, and today they're averaging 7%. That's astounding. Not that 7% is an historically high interest rate, but to have that increase from 3.5% to 7% is quite dramatic. Commercial permanent mortgage rates, permanent mortgages on commercial property, and that means by permanent, it means properties that have been fully constructed, that they're not in the construction phase, are averaging nearly 8%. And construction lending, loans on new construction, are currently averaging more than 12%. These numbers are quite high, and we're not seeing any signs yet that they're ready to come down. Now we're going to look at some encouraging signs that we are seeing the beginnings of a cool down in the economy, and therefore that there is reason to hope that we will finally see the decline in interest rates that has been talked about so much sometime later this year. What's been added to this chart is the red line that you see, which, different from the inflation rate as measured by the consumer price index, which has fallen from 9% to 3.4%. The red line is referred to as the core personal consumer index. And what we're looking at here essentially is the inflation rate after removing Food and energy. Why are those removed? Because they're very real expenses that consumers are struggling with. But those expenditures, the price of food and the price of energy, is less stable. It can react violently to shifts in markets, which tend to be short-term in duration. The PCE core index is coming in right now at only 2.8%, less than the 3.4% headline CPI. And this suggests to us that we are going to finally see lower rates of inflation and therefore lower interest rates as we get deeper into this year. Another sign that we're seeing inflation back away, and this is very significant for real estate development, is that the annualized increase in construction costs to build real estate projects is now increasing only nominally. In northern New Jersey, over the last year, costs have increased by 2.6%. In southern New Jersey, they've essentially stayed flat at only 0.3%. These are very sustainable and absorbable increases in construction cost compared to where we were just a couple of years ago when the cost of building new construction was going up at 18 to 20% per year. Not very long ago, just back in 2021 and early 2022. This is further evidence that inflation is finally starting to yield. But that we have cost inflation, which is far more reasonable, more normal today than we did in the past, does not mean that we've had a recovery or a reversion to normal for costs. And you're going to see that number here. This is a little confusing, but what I want to point out to you is that even though the annualized increase in construction costs has slowed, today in northern New Jersey, costs are up 31% higher than they were pre-pandemic in early 2020. And in southern New Jersey, they're up by 27%. That's a cumulative change. If we take a look only at the apartment market here in New Jersey, over that same time period, rents have only increased by 22%. And as you may know, rents are a proxy for what happens to the value and the cash flows for constructed real estate. And so we have the cost of building new projects having gone up by quite a bit more, about 50% more than the rent, the revenue, and the value of that completed project. And that's why the need for pilots and economic incentives has been increasing over this time period, even though income-producing property is more or less more valuable and more profitable on the face of basic rent cash flows, that the cost to build these has gone up by more than that increase in revenues is why requests and needs for pilots is actually intensifying. More evidence that we're beginning to see that cool down that I mentioned. We're looking nationally, and you can see that the pace at which new jobs are being created is slowing. Over here, you can see that what's called initial unemployment claim filings is actually rising. That means that there are an increasing number of people who are being laid off from their jobs. These are indications of a cooling period that is beginning to take shape. If we look at New Jersey specifically, in the most recent month of data that's been reported for April, there was a fairly sizable net loss of 11,000 jobs during the month. And the unemployment rate in New Jersey has risen rather sharply, now being the fifth highest in the country. And having realized the most rapid rise in unemployment in the country, further evidence that we're beginning to see a cooling. Here's another signal that suggests to us that consumers are going to be spending less and that therefore the rate of inflation will be falling. The delinquency rates on both credit cards and consumer debt have increased substantially, about doubled over the last couple of years. Consumers, the way that consumers were able to continue to spend and pay the costs of their lifestyle in the face of very high inflation was that more and more consumers were relying upon their credit cards and consumer loans in order to close the gap. What's happened today is that consumers are falling behind on making those payments. That means that banks are increasingly saying no when the consumer asks to have their credit limit increased because they've run out of road there. They spent up to their limit. And that as a result, consumers will have no choice but to scale back their spending. On a very encouraging note here, I'll point out to you down at the bottom of this slide that the delinquency rates for home mortgages, both nationally and in New Jersey, are at historic lows. Only 1.7% nationally for mortgage delinquency, only 1.1% of all mortgages being delinquent in New Jersey, so only 1 out of 100, compared to 2 and 3 times that for consumer debt. What this tells us is that while we are likely heading into a cooler economic period, this time that cool down will likely not be associated with elevated rates of mortgage delinquency and the massive numbers of foreclosures that we saw in the prior reset at the time of the Great Recession and the financial crisis. We're not going to see that this time, and that's largely because banks have been much more prudent, careful, judicious in terms of approving mortgage lending in the current cycle. So that is very good news. More evidence of a cool down we can see here is that we're seeing sort of this downward trend in spending for retail and food services. We've had the price that businesses are charging for their goods and services actually decline in 5 of the last 7 months. And so a period of economic cool down seems to be waiting in the wings, and with that, the expectation of lower interest rates. I next want to speak to what's been happening in New Jersey with demographics, and there sure has been a lot. We'll begin here with this slide on net domestic migration. New Jersey has been suffering from a net loss of population as measured solely by domestic migration, the number of people leaving New Jersey to move to another state versus people coming to New Jersey from another state. And you can see that these numbers are pretty staggering, right? Whoops, let me just back it up here. Are pretty staggering. Going back in the early 2000s, we were seeing net losses of 20 or 30,000 people a year. That sort of jumped way up to around 80,000 per year from 2010 through 2019. The pandemic hit in 2020. There is no data on domestic migration. The Census Bureau was unable to track this that year because of the massive disruptions. But if they had been able to track it, we would have seen that New Jersey had, instead of net out migration, net in migration during that period. due to the very large number of New York City households who decided to leave the city and come to New Jersey. This was a trend across the country where urban dwellers were moving to suburban places, first to try to put some distance between themselves and the virus. High density populations have higher transmission rates. Secondly, elevated crime rates. And thirdly, work from home, remote work, hybrid work made that sort of pave the way for that migration to the suburbs. But then you can see that in 2021, we got back onto a negative track with about 50,000 net loss of people leaving New Jersey to go to another state. And in 2022, the most recent year that we have data for, more than 90,000, more than a net loss of nearly 92,000, more than in any of the prior years. This is significant. And over time, it's not sustainable. We must find a way as a state to reverse this in order to ensure a prosperous future for everyone in our state. In terms of the highest outbound states, the largest outmigration in 2022, we don't have 23 data yet, were people moving to Florida. We had 47,000 people leave, and then we had about 10,000 people come back from Florida, so a net loss of 37,000. You can see that the second largest outbound movement is to Pennsylvania, but there was about 2/3 of that coming into New Jersey at the same time. And you sort of get to see the state-by-state movements. The only state that we had a positive relationship with, where more people moved in than moved out, is New York State, where in 2022 we had 38,000 people leave, but 75,000 people move in. And that's sort of that flight from the city, flight from urban areas, which was a national trend, and of course becomes even and ends up being sort of advanced by work from home models where you don't actually need to go to your job in New York City every day, or perhaps at all in a work from home environment. But now we're going to take a look to see what the composition of the people leaving the state has been recently. Now here we're looking at 2023 data. And on the map, any state colored in yellow had more people leaving than moving in. And in New Jersey had the highest outmigration rate in the country in 2023, with 65%, 2 out of every 3 household goods shipments. What does that mean? When people put their home onto a moving truck, put their furniture and their belongings and have it loaded onto a moving truck, 2 out of 3 times that truck is leaving the state rather than coming to the state. Look, that's not a place that we want to be in these rankings, having the highest outmigration rate. When we look at why people are leaving, and I want to focus on the inbound column here, this is very concerning for us as a state. Sort of the conventional wisdom is that it's difficult to for retirees to be able to continue to live in New Jersey once their income drops at the point of retirement. And so it's not so much unexpected. It's not very surprising that those who are retired and now living on fixed incomes would be leaving the state. But what you see from this data is that people leaving for that reason are in the minority. Only 27%, 1 out of 4 people who left the state in 2023 left because of retirement. And then when you look at some of the other aspects here in terms of lifestyle, job relocation, costs, family reasons, overwhelmingly, most people leaving New Jersey are not retirees, which is very concerning. Another sort of alarming fact that we see down here is that the income of those leaving New Jersey, 52% of the outbound migration from New Jersey have the highest incomes in the state, earning $150,000 or more. And so the people who are leaving New Jersey are not majority retirees and are earning enough to be able to continue to live here. They're just choosing not to. From one year to the next, or from one year to the next, to the next, to the next, is not so much of a threat, but that this has been continuing now for 20 years over time sort of erodes the economic fabric of our state. And it is something that we'll need to find a solution for. In terms of what happens next, what you see here is a recent poll from Monmouth University asking residents, what are your plans in the future? And it's, again, very concerning. About half of everyone living in New Jersey is planning to leave. And for those who are 55 and older, that's the smallest cohort of adults, households planning to leave. It is actually the younger age cohorts, 18 to 34 and 35 to 54 years of age, who plan to leave in the largest numbers. And so this is something that we need to spend some time figuring a solution to. At the end of the day, it's about costs of taxation, costs of living, costs of housing, the availability of affordable housing, and the availability of affordable transportation. All of these are driving factors. Here's some more shocking data for New Jersey's demographics. Today, 71% of all households in New Jersey have no children living at home 18 years of age or younger. 71%. Now, just in the last 2 years, that ratio increased from 65% to 71%. These are households. So what this means is that we are talking about housing units, plan units, whether they be homes or townhomes or apartments. Nearly 3 out of every 4 rooftops have no children living at home or childless. And you see this in the data here in terms of the average size of households in New Jersey. More than half are only 1 or 2 persons in size, nearly half. And the minority, the smallest number of New Jersey households, are family households with 3 or 4 or 5 or more persons living at home. This is a tremendous shift from where we were 50 years ago. This is attributable to the decline in birth rates that we've seen not only in New Jersey, but globally in recent years. There are many reasons why birth rates have declined. One of them, certainly over the last 50 years, is that women have become more present in the workforce. And a large part of it, at least here in New Jersey, is that having children for many is unaffordable. The average cost of childcare for one child to go to some sort of a daycare is $20,000 a year in New Jersey. For the most part, you would be paying for that with after-tax dollars. And it's just not affordable for most, particularly if you need to give up a salary for someone to stay at home with the children. This has very significant implications for housing demand in the future, because fewer children today means fewer adults tomorrow. And it is tomorrow's adults that drive the demand for housing. And this is particularly concerning for apartment demand heading into the future, because as you know, we're building a lot of that for a variety of reasons. Certainly, the affordable housing settlements are one of the factors driving that. Also, the fact that most households now are smaller in size, only one or two persons, is also driving demand for smaller living units rather than larger single-family houses. But this is a problem that we'll be facing, and we'll see more on this in a little bit. When we take a look at the change in the population of New Jersey's households, just going back to 2010 versus today, we're looking at that here by age cohort. And what you'll see very quickly is that we are continuing to see rather large population increases in older age residents, baby boomers, still growing rapidly in numbers, largely due just to the aging process of people who were not baby boomers 5 years ago or 10 years ago, which have now aged into that category. Cohort aging is what that's referred to. But then when you look at what's occurring in the prime working age groups here in our state, we're seeing little to no growth in the number of millennials and the number of Gen Z young adults. This is another concern. This is that knock-on effect of cohort aging, where if 20 years ago there was a decline in birth rates, 20 years later, there will be fewer 20-year-olds. This is a very critical aspect for employers who focus their recruitment and hiring efforts on recently graduated young talent to come and work for their companies. And so if this trend continues, it will become more difficult to retain those employers because they may get starved out in terms of being able to hire their talent. And it's also a big concern here for apartment demand, which, as you know, is being constructed in very large numbers. Here is a projection going forward of the change in the number of adult households. This is households, not persons. The change in the number of households over the next 5 years by the age of that household. And you'll see here that our projection right now is that within a 25-mile radius of New York City, the number of households with a head of household between the ages of 25 and 34 will decline, will be reduced by more than 100,000 households in the next 5 years. We need to spend some time talking about this and thinking about this. And at the core, at the root of retaining and attracting this age group is modern, affordable housing choices where you do not need to spend 40 or 45 or 50% of your income paying for your housing costs. Next, a look at what's going on with construction spending. And over here, we have some interesting trends developing. As many of you are acutely aware, we here in New Jersey do not like it when more things get constructed in our local communities. And probably at the top of that list are construction projects that generate school enrollment, and distribution warehousing has been added to that list quite recently. And what we're looking at here is how new construction starts in New Jersey in the first quarter of this year. So we're now in the second quarter, which is not yet completed. So in the first quarter, which is the most recently completed quarter in New Jersey, spending for new construction starts. These are new projects going into the ground for multifamily projects, declined by 69%. So we're seeing a significant slowdown in the start for new construction of multifamily projects. That is an artificial external distortion that's causing that. It's the very high interest rates, because today you will likely, if you're going to build a project, your debt servicing, the interest payments to the bank at today's interest rates will likely be greater than the net income that you realize from the completed project. So that's just that inversion that we saw earlier, where construction costs have gone up faster than rents. And therefore, since the value of income producing property is a derivative of how much are the rents, that we're seeing a significant pullback here in the start of new multifamily construction projects. Just doesn't make sense at today's interest rates. That is a temporary cycle, however, and we can expect, and that's even though you're seeing pretty much new construction projects sprouting up everywhere you look. That's nothing compared to what we will be seeing once interest rates normalize and those construction projects become more affordable. Here's another number that we'll take a look at here. Industrial new construction starts increased by nearly 500%. And so that is an element here that is not pulling back for new starts and is actually beginning to accelerate. And that's because the demand, the need for distribution warehouses, fulfilling online e-commerce spending is still only about in the third inning of a 9-inning game in terms of how that will fully develop. Here you can see that the number of apartments being constructed in New Jersey has fallen from about 40,000 down to about 34,000. That's an interest rate dynamic. And the amount of new construction for commercial projects has declined as well. Again, largely an interest rate dynamic. Now we're going to take a look at some of the real estate sectors around the state to see how each one is performing individually. This will be relatively fast-paced because each of these asset classes could easily fill an hour or two all by themselves if we were going to do a deep dive, which we don't have time for. We're going to start with home sales, which is probably the sector that the public follows the most and is most interested in. If you're an existing property owner, you're very interested in knowing how much is my home worth in today's market. It may be just because you'd like to know, or maybe because you're thinking about selling it and buying another one. So we'll begin with that. And there's a lot going on here, but what I want you to see here is that going all the way back to since May of 2021, so over the last 3 years, let's call it 37 months, because that's what we're seeing here. The number of home sales occurring in New Jersey has fallen in every one of those months, except for the 2 most recent months of that we've just passed through here, being April and May, where the market was able to eke out just a very nominal 4% increase in home sales in April and a 2% increase in May up through the 3rd week of May. And that's projecting what it would be for the full month. And so this is pretty much an indication of complete collapse in the housing market. And you can see that over that whole time, interest rates have been going higher and higher and higher. And so that's sort of the affordability tax of having higher interest rates. And I might point out that when the Federal Reserve decides to raise interest rates because of runaway inflation, What you see here is precisely the intended consequence that they're aiming for. The Fed raises interest rates with the hope that the higher interest rates will make it unaffordable for consumers and businesses to continue to participate in the economy, so they stop spending and stay put, reduce their consumption, which would then lower inflation and allow interest rates to normalize. That's exactly the intended outcome. And so it's not surprising that we've seen a sharp pullback. And up at the top, you can see what's happened over this time period. In 2021, when interest rate increases were just getting started, we only saw a 2% drop in home sales. In 2022, a 20% reduction in home sales. This is not in values, this is not in selling prices, but in terms of the number of houses that are selling. In 2023, 18% fewer homes were bought and sold. And in 2024, year to date, a small 3%. So we've seen the pace of home sales fall by nearly half as interest rates have gone higher and higher. Again, that is the intended outcome of raising interest rates. And as a result of that, the pace of home sales in 22 and 23 was $22 billion less than what occurred in 2021. That's a lot. And real estate brokerage businesses, companies, businesses that are in the business of helping buyers and sellers to transact home sales, saw about $1 billion less in commission income, devastating effect on real estate offices. We'll talk a little bit about that later, but there are big changes coming for the home real estate brokerage industry. Now we'll see just a quick timeline of how this played out in each year, starting with 2019, which was before the pandemic set in. You're looking at a normal seasonal pace in home sales where the number of sales monthly in 2019 increased from January to February to March to April to May. That's the spring housing market as it's referred. Then there is a cool down period, which typically happens in the summer months. There is a bump in October, which happens every year in the housing market. And then the winter cool down that happens later in the year. So there's 2019, no influence of the pandemic. Here's 2020. You can see that extraordinary jump in the pace of sales in the second half of the year. Those are New York City households fleeing the city and coming and acquiring housing here in New Jersey. You can next see that in 2021, there was a sort of a normalization. It looks an awful lot like 2019, just a little elevated. Here we look at 2022, the weakest year. Here we look at 2023. These are interest rates now pressing down, tamping down, then reducing the number of people who can afford to buy a home. And then we look at 2023, where we finally sort of bottomed out recently, and we're kind of hitting in 2024, we're sort of hitting the 2023 comps mark. And you can see that the housing market has been significantly affected. Under any other circumstance, this slide would mean that home prices would be tumbling, that home prices would be losing 5 or 10 or 15% in value a year. That has not happened. And the reason it's not happened is that the number of houses on the market today is about 75% fewer than we would expect to see normally. 13,000 homes on the market in New Jersey today. We would expect to see 45,000 homes on the market in normal circumstances, 2019 being a pre-pandemic year, which was actually a very good year for the housing market, where inventory was considered low in 2019 because of how well the economy was doing. And nonetheless, today we are down dramatically. Why is that happening? Because if you're an existing homeowner, you just don't want to walk away from that 3% mortgage that you have on the home that you currently own and trade up to something else and have to give up your 3% mortgage and graduate to a 7% loan. You don't want to do that. And because you don't want to do that, you're not trying to sell the house that you're in. And as a result, we have this inventory shortage. There are other contributing factors, but this is the primary one. It also suggests to us that when interest rates normalize, we're going to see a sizable increase in the number of houses that are on the market. And so that supply and demand balance is likely to shift. Here's a trend in prices that we've seen. This is nothing short of extraordinary. I'll tell you what's normal. Over the last 50 years, home prices in New Jersey have risen at an annualized pace of 5% a year. And here we have this extraordinary increases in home prices over the last 5 years, including today, which remains elevated with a 6% pace that we're currently experiencing. This is unprecedented for this length of time, and it's probably unsustainable. There is a very enormous possibility that when all of this settles out, that people who've paid $10,000, $50,000, $100,000 over asking price may find themselves in a few years with a home that's worth less than they paid for it when we finally start to normalize. Here we're looking at the quarterly increases in prices. You can see that it's slowing, and we expect that we'll get down to very nominal home price increases in a couple of years. Commercial real estates. I'm going to go through this quickly because this is a very deep topic and we don't have the time. But the availability rates really sort of tell a story in normal. And what availability tells us is that the strongest segments in the commercial real estate market continue to be apartments and retail. Retail properties have been performing quite well with only a 5% availability rate. What does that mean? Only 5% of all retail space is currently being marketed to look for a next user, a next business to move in, and an even lower availability rate for apartments. Even though availability and vacancy have gone higher in apartments over the last year, these are still very healthy rates. But when we look over here at what's called Class A office space, these are the highest quality, largest size office buildings in New Jersey. That availability rate increases dramatically, more than 20%. Why is that? Well, certainly part of it has to do with the outmigration of people and businesses. Part of it has to do with high costs and high taxes. But the largest component of this is a rethinking of the need for office space by businesses. Many businesses continue to have employees work from home some of the time or all of the time. That reduces the amount of office space that a business needs to run its business. And as a result, values on office buildings are tumbling. This is a risk dashboard indicating across New Jersey, and we can just sort of ignore this part of the slide and this part of the slide, which are New York City, downstate New York, and eastern Pennsylvania. And when we focus on the left, here is sort of a county by county, property type by property type review of the strengths and weaknesses in the real estate markets. And for the most part, what you're seeing here is that there are more greens and yellows than there are reds. Reds are markets that are showing signs of distress. And so it remains a relatively healthy picture, even though we're seeing price declines. And here you can see what's happening to the value of commercial real estate in New Jersey. Going back early last year, commercial property values peaked out at an index of 154. That means that prices in last year were about 54% higher, 154% of where they were in 2016. And we've seen that prices have come down generally over that time period. When we take a look at the deal flow, the amount of commercial investment happening, you can see that this market has been decimated. We've gone from $13 billion in investment real estate sales in 2021 and 2022, down to right now a pace of about 4 billion. This is that interest rate dynamic. If you're going to be paying more in interest to the bank than the net income before debt servicing from the ownership of the property, it's not a tenable, it's not a profitable, it's not a viable investment. When we take a look, here's the retail market. We're seeing a slight downturn in values, which you would expect with high interest rates. We're starting to see an increase in vacancy, but at very nominal levels. But we are noticing that the number of businesses closing is now greater than the number of retail businesses that are opening. So we need to keep a careful eye on that and see how this interest rate dynamic cycle will affect the value of retail property. In the apartment market, you can see that apartments are less valuable today than they were back in 2022. Once again, that's principally the rise in interest rates, but it also has something to do with the rapid pace of construction that's been happening in that sector. Here you can see that vacancies in apartment buildings have been going higher, but still very manageable at 4.8%. What's most concerning is that the absorption pace, the pace at which apartments are being rented, has slowed rather dramatically. It's less than half of what it was a couple of years ago. And that spells higher vacancy and lower achievable rents in the future. Taking a look at warehousing, in spite of the fact, maybe we'll go to the next slide first and go backwards, in spite of the fact that vacancy has gone higher and that rents have flatlined in the industrial market, notwithstanding that, the price that investors are paying for industrial real estate is going higher and higher and higher. And that's because when someone purchases an investment property, the price they pay today is a reflection of what they expect the revenues from that property to be in the future. And distribution warehousing is still in the early stages of its full market expansion. And finally, office buildings, where we've seen about a 20% decline in New Jersey in the selling price of office buildings here in New Jersey, nearly a 40% decline in New York City. And this is because of that work from home dynamic. You can see that vacancies are elevated and the market is generally underperformed. So now that we've covered all of that, we're ready to talk about what does this all mean and where do we go from here? And I'll begin here by pointing out, as you may know, that the stock market continues to be very optimistic. I'm looking over here to see what's happening today. The 30-year fixed rate mortgage has actually risen a little bit in terms of the interest rate, and the stock market is going higher. Investors on Wall Street are very optimistic because they believe that once the Federal Reserve begins to lower interest rates, that the economy is going to go on an extended growth run. However, when we look at consumer confidence on the right, and this is sometimes referred to as not Wall Street, but Main Street, the mood for consumers on Main Street is actually quite sour. And that's an inflation story. I mean, there are other reasons for it, but largely it's that inflation has been so high that most are finding it difficult to afford the cost of living, finding it difficult to be able to achieve the dream of home ownership because of how expensive everything is. And this is sort of the big story. It's not only a big story in economics, but it's also a big story in politics. And so in terms of our forecast for what we think is going to happen, we think that we're going to get to some sense of normalcy in 2025. What does that mean? That means inflation rates, which are maybe not all the way down to 2%, but are below 3%. let's say 2.5%. That means that interest rates, which are now coming down instead of staying at very high levels. And that expectation is because we seem to be at the point where this inflation fever is getting ready to break. The possibility or the potential for a recession, which is a sort of a harder reset in the economy, where several million people lose their jobs, is increasingly unlikely. We see that as only a 10% probability today. We think that inflation will slow later this year, and with that, we'll have lower interest rates by winter. There should be a real estate rebound as that materializes. Banks will become more willing to lend. We'll see more deal flow, more homes being bought and sold, more commercial and industrial assets being bought and sold. And we think that home prices are going to stabilize by next year, and that commercial real estate prices will stop going down and start to go higher. In terms of the future for the housing market, a very big concern here is that demographic cliff that I pointed out to you earlier. The fact that the drop in birth rates 20, 25 years ago is going to result in fewer younger age adult households is very concerning. And for those of you who are planners advising local municipalities, here's what I can tell you with certainty. If you don't have young people and young adults laying down roots in your community, you are in a death spiral that you can't pull out of. And so from a planning perspective, I'm going to talk about that a little later, it means that towns need to think about not only approving or yielding to the construction of multifamily apartments, but also thinking about permitting and, in fact, zoning for and encouraging smaller size home ownership choices, something that's smaller than large lot single-family homes, in order to attract that very vital demographic. Because without young people coming into your community, there's no one to sell your home to when you're ready to move, and employers are forced to go somewhere else to be near to a talent pool that they can recruit to work in their businesses. On buyer brokerage in the housing market, this is just a huge concern that we see going on here. Not only have the commissions to brokerages in New Jersey declined by nearly $1 billion over the last 2 years, we now have new rules which are being implemented this summer, which will significantly reduce the revenue stream to New Jersey and national real estate brokers in representing buyers who are purchasing homes. And so we are expecting to see a very large scale contraction. We are already seeing evidence where chain real estate brokerages selling housing are consolidating 2 offices into 1 or 3 offices into 1. And we think that's just getting started. And finally, as I mentioned earlier, there is a real risk of home price declines in the future. Why do I say that? Well, for a couple of reasons. Number one, looking back at history, and before I walk you through that look back, I'll acknowledge that what we've been experiencing here over the last 4 years is unprecedented historically. And so the future may have no correlation or have less correlation to the past as we head forward. But historically, any time in history when home prices have risen faster than incomes, there has been a period of home price declines which follow eventually. And that's pretty easy to digest because in the end, homes can only sell for as high a price as buyers have the income to pay for. And we've seen a complete divergence from that since the onset of the pandemic. Why is that? Well, certainly some of it has to do with higher interest rates, and existing homeowners not wanting to give up that 3% loan and therefore resulting in less availability for buyers to choose from. And as a result, this sort of supply and demand imbalance, which encourages prices to appreciate rapidly. But there's a larger reason for this extraordinary home price increases. And that reason is that the principal reason that home prices have gone up so much in recent years is that following the pandemic, we had large numbers of New York City households come to New Jersey. The same job in New York City pays a higher salary than the same job in New Jersey. And so we had large numbers of households with inflated income coming into the New Jersey housing market at a point with low inventory and bidding prices up to the level where New Jersey households can't afford to pay those prices. And so there is a real risk of home price declines in the future, but not in the near future. It's not something that's going to happen in a year or two. But when we get past that, it's a real possibility. So finally, a little bit about how do we plan for our future. I do just want to point out to you that technology plays the role of eliminating jobs in the economy. And yes, technology creates jobs. People working for the company that are either inventing the technology or deploying it. But technology eliminates more jobs than it creates. And we have evidence of that everywhere in the economy. There are whole sectors of the work economy that no longer exist. People in warehousing, stocking shelves or filling orders. That's now done by robots. When you go into the grocery store today, I just was in the grocery store yesterday, and sort of mindlessly, I like to go to the self-checkout aisles because it's quick and easy. And I didn't have a lot of items, but then I just glanced down at what the cashiers were doing. And the three that were actually on shift were standing there with their arms folded. It's just a matter of time before those jobs, which have been reduced in number already, just go away. And you've probably seen the new technology where you don't even need to take the items out of your shopping cart. You go through a scanner, which understands everything that's in your cart because it can read it, comes up with a total and charges your credit card as you just push through with your cart. The travel industry, I needed to take a business trip not long ago out to the Midwest. And I needed a flight, I needed a rental car, I needed a hotel room. I did it all on this device in a matter of minutes. And there was a time when there were legions of people working in travel that I would have needed to go to get that all to be done. And we have a lot more shocks coming, eds and meds. Just think about how remote learning will impact enrollments at colleges and universities. Think about the medical profession, where increasingly visits to your physician will be virtual, telehealth or telemed, instead of physically going to the office, which will reduce the need for physical office space. Groceries, which really hasn't begun yet. I mean, you can shop online for your groceries, but it's such a primitive process where you use all this tech to pick out your items, and then someone is walking up and down the aisles of the grocery store to fill your order. That's not the plan, I can tell you. And pharmacies are about to go through an absolute revelation because so many of the large pharmacy operators have already told us what their plans are in terms of what the future looks like. Oxford University took a look at this. And what they predicted 10 years ago was that by the end of this decade, 49% of all the jobs in the United States will no longer exist because of technology. So we as a state, we as a people, we as a community, we need to focus on doing everything we can to not only retain the jobs we have, but to create an environment where businesses want to be here to be able to offset these unavoidable shifts that are coming as we move forward. And I would say that it's even more of a compelling need here in New Jersey than other places because of our very high costs of housing, our very high costs of real estate. If we hope to be able to retain the people who are living here, which will mean that they'll need to be able to afford to stay here. And the demographic numbers we looked at here said that the people who are leaving principally and in the majority are not retirees. If we want to be able to maintain the incredible success that we've had in our state, which is one of the most amazing success stories in the United States, if we want to be able to maintain and preserve that, we're going to need to think about how we not only maintain the jobs that we have, but bring new ones in. Shifting to planning, costs and taxes matter. Change is perpetual. We have been now for about a decade in this transition to a European model for our economy. And in many ways, we are now the new Europe with very high costs of living and costs of business operation, very high taxes, lots of regulation, and a lot less upward mobility for young people to be able to climb the ladders of success. And so at some point, we're going to need to pay attention to this. And again, this is not something that has to be fixed today, but over time can lead to death by 1,000 cuts. In the end, people are going to choose to live in places where it is more affordable. And over time, that can be lethal if we don't give it attention. There's a lot of talk about energy policy. I applaud all of the things that New Jersey and our governor are attempting, the change that is being attempted. There's an undeniable need for all of that, but we need to be sure that we move forward thoughtfully. And I say that because there can be unintended consequences to energy policy, the most significant of which is that moving away from fossil fuels makes the cost of energy more expensive, which is a direct threat to suburban and rural places because they are distant and require cost to get to and from. And so we should be focusing on energy policy, but it needs to be done very carefully. We need more redevelopment areas and more financial incentives to plug the leaks in the affordability equation and in the feasibility equation. Something that I think is lost, even if we go back prior to the current high interest rate cycle, is that for a while now, for the last 10 years, there has been an increasing number of projects that could not be built but for various concessions and incentives, could not have been built because the cost of full ad valorem taxation would have rendered the project infeasible. Meaning that it wouldn't have been able to generate enough of a financial gain, financial benefit to the developer after paying taxes. And so we had a very large number of cases inside of designated redevelopment or rehabilitation areas where property taxes have been abated in some way. I just want to make it clear that when those things are necessary, it is an admission of failure. It is an acknowledgement that we have a landscape now where in order to see progress, in order to see development, and there is no alternative to that. Either you're growing or you're dying. But in order to see the growth, we need to incentivize developers so that they can make money instead of lose money. That's a problem. That's a relatively recent phenomenon that we've come up against, and we need to address that at the core. I have a note here on consensus building. I find that in this age of increasing availability of data and information, the public seems to be getting to be less and less informed, and that may be one of the downsides to having access to a lot of data. But as someone who've attended many hundreds of local zoning and planning board meetings, what I walk away with every single time in listening to the comments from the public, which of course it is a vital part of our process. But what I walk away with is understanding that the public really doesn't understand much in terms of how to plan for the future. And at some point, we're going to need to have a concerted consensus building effort to be able to educate the public so that they will be supportive of initiatives to grow our economy and to create prosperity in their local communities. Housing diversification, I talked about that earlier. Yes, there is a compelling need to build multifamily apartments. Not only because of the set-asides in inclusionary projects, which create a place to live for people who find it very difficult and unaffordable to live here, but also because apartments were underserved for decades here in New Jersey. We just weren't building them or enough of them. But we need to look beyond that. And we need to look to small lot, single-family homes and townhomes. Because if a young person coming out of college who's been working for a few years looks at the cost to buy a single family home or a townhome and comes to the conclusion, I'll never be able to afford that, they will be leaving. And so we're going to need to rethink how we can create these opportunities for higher density home ownership options, which will be very beneficial to local communities in a host of ways. Looking ahead, data centers are going to be the big thing in real estate development. Unfortunately, they require massive amounts of power to be able to operate. They are one of those instances where technology creates jobs rather than eliminates jobs. And so we have some challenges there to figure out how we're going to be able to create zones, locations that can have the power infrastructure available to be able to attract this sort of new leading edge of the development trends. Refrigerated warehousing will be a really big deal. You've probably heard about the Gateway Tunnel project, which is now underway. The Transportation Secretary has given the green light to that project. This is a really big deal for New Jersey. On the surface, it may not seem like all that much because ultimately it creates a pathway to New York City and particularly to employment in New York City. But it's really going to do much more than that. And in a wide number of ways, this tunnel project is going to create opportunities for development and redevelopment in secondary and tertiary markets, which should be planning for that today. When finished, this project will double the capacity of the rail system going from New Jersey to New York City beneath the Hudson River. It's going to double it when it's all finished. It's going to take a while. It'll take a decade because there's various components to this. But when it's finished, it's going to double the capacity, which means that there will now be an opportunity for train travel to move faster because there's less congestion, less of a bottleneck to get underneath the river, which means that locations which are more distant may have now more reasonable connect times on the train, which opens up the opportunity for economic growth. So towns should be thinking about that and how to create zoning which encourages, which facilitates the kind of development that would prosper from improved rail connectivity. New York City is sort of a tough story to watch economically. It continues to struggle. It's not gotten back. It's not recovered yet from the pandemic. It has a long way to go. And on the one hand, that's very threatening to us here in northern New Jersey, where I live, because without New York City, all real estate, selling prices, values, and rents is probably 30% overpriced without New York City as being the epicenter of that economic engine. So we should all be rooting that New York City will get its economy back on track, get its employment and its office participation back to where it was, because we benefit from that. At the same time, there are tremendous opportunities that come from New York City's challenges, because historically, here's another historical correlation. Every time in history that a population has relocated from one place to another, the job creators and the employers follow that trend because they need to be near to where the workforce is actually living. And we've seen this both in positive and negative ways in New Jersey over the years, but there is a tremendous opportunity here to be able to attract employers to come here now that much of their workforce is living from here, because first, proximity has advantages, and secondly, you'll have less resistance to getting your workforce to come back into the office. And finally, my closing comment here is that places that do not adapt will be left behind. Change is hard for everyone, but from a planning perspective, if we are not planning for future success, then we are accepting future failure. And so please continue to inform your local constituencies of not only the need, but the benefits of being on a growth trajectory rather than a declining trajectory. And that brings us to the end here. And we are doing well with time. And so I am going to go now to the Q&A. What I'm going to do is stop sharing my screen. There we go. So I'm going to go to the Q&A now. And we do have some questions in here. So the first question comes from John. And John asks, what would be the signs that we have entered a hyperinflation environment? Well, two things, John. First, that in the benchmark that the Federal Reserve uses is that hyperinflation is anytime inflation gets above the 2% mark, and we've been there for a while. And the second sign is the slope of that curve, how quickly the rate of inflation had been rising, and we went from 2.5% to 9%. Inside of a 24-month period. It was clear to everyone who was paying attention that we were in a hyperinflationary environment. I don't mean for this to be critical, but initially the policymakers in Washington, D.C., including the Federal Reserve Bank and including the Secretary of the Treasury, we're making comments like, well, we think this is temporary. We think this is transitory. We don't think it's anything to be worried about. And unfortunately, it was that lack of attention that allowed inflation to build up such a head of steam that the only way to change it was to make drastic increases in interest rates. And real estate markets have been feeling the effects of that now for a few years. So Tom asks, what he's essentially asking is, does inflation really need to get down to 2%? Could it be something a little higher than that in order for interest rates to come down? And the answer is yes. The Federal Reserve has said again and again that 2% is their target. But it's an open question as to whether 2% is even achievable anymore, because We in the United States run a deficit spending here consistently. And that means that the money that we spend to run our government comes from borrowers who need to lend us their money to do that. Bonds would be the typical mechanism for that. And that with the high level of government debt that we have now, it may never be possible to get back to 2%. So, Tom, I agree with you. I'm not sure that we actually need to get to 2%, but we're going to need to get down toward that 2.5% with a real chance of getting to 2% in order for interest rates to be able to come down. Denise asks if the 22% increase in rent is only for newly constructed projects, and the answer is no. The 22% increase in rents is for all projects, all rental housing here in New Jersey. Some will have done a little better, some will have done worse. Margaret asked about the source of the moving data. That was the migration data, which showed that New Jersey had the highest ranking of outbound migration in the state at 65% of household goods shipments. That study, you can find it online. It's published by United Van Lines every year in January. The January report in 2024 was based upon their findings in 2023. I'm just reading through a couple more questions here. Yeah, so Tom, I appreciate your skepticism, because being skeptical is a part of the scientific process. You need to kind of show me. But Tom says he's wondering how, I'm paraphrasing, how over time will young people really want to live in Florida and other states? And then, I'm sorry, I should have read on. And then it sort of gets political, which we'll leave out. But I don't think that Florida, I don't think that this trend is not so much a Florida dynamic. If we're talking about young people, because while Florida was the largest out-migration state in 2022 from New Jersey, inside of that demographic, they were principally not young households, young adult households. The concerns are not that young people will want to live in Florida. The concerns will be, will they choose instead to live in Austin, Texas, or Denver, Colorado, or other markets around the country which have strong economies and more affordable housing choices. I think we have time for one more question. Yeah. So that's a good comment, Daniel. Daniel is saying that he finds it to be counterintuitive that the high income level of households leaving New Jersey would imply home ownership. And yet the number of houses on the market is so very, very low. Not all of those are homeowners, Daniel. Certainly a large portion of them would be. But if $150,000 is your household income, and you live in a place where the typical home selling price is $750,000, probably won't be able to afford it. Okay, so it looks like we are finished with the Q&A. And Tim, is that you coming back on?
That is me coming back on, Jeff. All right. Well, thanks a lot, Jeff. Once again, you've given us a lot to mull over. And thank all of you for attending.